Welcome to the Rockstar Investing Podcast, where we look at what separates average traders from those who are absolutely crushing it. If you're ready to be an investing superstar, keep listening. If you want to get there faster, visit www.passiveincometrading.com. And now, your host, the Rockstar Investor, Nick Roberts.
G'day ladies and gentlemen, welcome to Rockstar Investing. Now, one thing I keep hearing constantly is this sort of fear and almost panic around the subject of investing and trading, and it stems from this belief floating around out there in the world that investing is simply just too risky to get involved in. And so for today's episode, I kind of want to dissect this belief and do a bit of a deep dive into whether or not we should believe this to be true. And rightfully so. I mean, if you're listening to this, then it's likely that you believe that investing is, at the very least, worth looking into, or else you wouldn't even be here, right? But I know that for many people looking to make their next investment, or even their first investment, sometimes this crippling fear takes over and ultimately leads to procrastination, which ultimately leads to inaction, which kills the investor's drive, and then it's simply a downward spiral from there, and the investor never gets ahead with anything. So let's now take a look at what it actually means to be an investor when it comes to taking risk, and really just ask ourselves, well, is investing risky? And to answer this question, I'm going to compare the idea of investing to driving a car. This is one thing we talk about in my book, actually, The Rockstar Investor. By the way, if you want to get yourself a copy, head on over to therockstarinvestor.com. It's a pretty cool book, wrote it myself. The book's free, so please head on over and grab yourself a copy. Okay, cool. So anyway, one thing I like to tell people is that when we're talking about risk in investing, is that investing is a lot like driving a car. Okay, so picture this. Let's say you're at the car dealership and you're looking around for a new car. And of course, there's a whole range of different makes and models. There's big pickup trucks, there's sports cars, there's old clunkers, everything you can imagine, right? Now, this is the moment where you pick your vehicle. So with investing, this means choosing the investment vehicle, or more specifically, the asset in which you'll be investing in. And so inherently, depending on which vehicle you pick, there's already a built-in amount of safety features with each vehicle, right? So for instance, the pickup trucks aren't as fast as, say, the sports cars, but the pickup trucks offer a lot more in the way of stability during harsh conditions, right? Or let's say the sports cars can be super quick, but they're a little touchy on the accelerator, and if you don't know what you're doing, you can spin out if you don't know how to handle them properly. And so, of course, choosing the right investing vehicle for you, the investor, is a lot like choosing the right car for you, the driver. Make sense? So, for instance, you might find that real estate is a great long-term, stable investment that slowly gives you a return over time, or you might find that Forex trading might be quick and dangerous, but yet has immensely high rewards if you're lucky and pick the market correctly. Now, here's where things get interesting. The most common mistake investors make is assuming that the risk in investing is squarely on the shoulders of their chosen investment vehicle. So that's kind of like the equivalent of saying that certain cars are safer to drive than others. And of course, there's a very real element of truth to that statement. However, the worst mistake we can possibly make as traders is putting all the responsibility when it comes to risk on the chosen vehicle. In other words, it's not necessarily the car itself that is the risky component, but rather it is, of course, the driver. So imagine this, right? Imagine you buy the safest car in that lot. It passes all the right tests, and it's the number one safest car in the country, so you go ahead and you drive that car out of the lot. Now let's imagine that the second you take the car out of the lot, you put pedal to the metal and you just floor it. You take sharp turns at 90 miles an hour, you dart in and out of traffic like a maniac, and you drive without headlights on and without windshield wipers during a monsoon rain season in the middle of the night. Now, tell me this, even though you've picked the safest vehicle on that lot, do you think that if you drive your car this way, that you'll end up being safe? And of course, nobody who drives like this would have a chance in hell. And so when we talk about risk in investing, we have to examine the most important part of the investing process, which is you. Now, regardless of which vehicle you've chosen, you have to admit that as long as you've chosen something that is somewhat sturdy and reliable, meaning that you're not looking at anything that shouldn't be registered because the wheels are about to fall off and it's simply too unsafe to get involved with. So as long as your vehicle is something you understand to be relatively reliable, the remaining risk, and in my opinion the majority of how much danger you're actually in, is up to you. Now thankfully that in order to pass your driver's test, you had to know how to safely navigate turns, how to obey the road rules, how to park, and how to operate the vehicle itself. Otherwise you wouldn't be allowed to drive at all, right? Now here's the problem. In the investing world, there's no such test. There's nobody giving you written permission that says, yes, you've passed your investor's exam, I now qualify to go out and do investing in an official capacity, right? We just don't get that in the world of trading and investing. And so this brings us both good and bad news. The good news is that we don't need anyone else's approval in order to be an investor, right? We can go out there and start making things happen at any time we want to. So that's the good news. The bad news is that there is no official process that we can go through to make sure that we know we're doing all the right things before we start risking our money on the proverbial roads with all the dangers and pitfalls that might be headed our way. And so if there's nobody in the investing world dishing out licenses or certification, that means that the bulk of the responsibility is going to be on our shoulders. Now, in this case, I'm going to give you 3 really good methods of protecting ourselves while trading that is kind of going to be the equivalent of the basic protective measures we take when driving down the road. So for instance, stopping at red lights and stop signs, making sure we're not exceeding the speed limit too much, making sure we aren't taking sharp turns at high speeds during wet weather. That's all going to help make sure we get from A to B in one piece. And so the 3 main things in the investing world we can use to avoid risk that are the equivalent of this are the following 3 things. Okay, so number 1, and this is fairly obvious, or at least it should be fairly obvious to most veteran traders, yet it's amazing how many people ignore this one and get burned as a result. But this one is, of course, using a stop loss. Now, this one is important regardless of whether you're trading something with a lot of leverage, such as Forex, or whether it's just something simple as regular stocks or regular shares, right? The main reason stop losses are useful to us is twofold. The first reason is that usually when we're trading something directional, so when we choose a security and we're hoping it's going to go up, or if we're shorting the thing and hoping it's going to go down, if we're wrong about the direction that particular security starts traveling in, a stop loss is a great way for us to systematically admit that we were wrong about our choice of direction, and it will exit us out of that trade immediately and without argument. And that means that there's no second guessing ourselves, no emotional battles we have to have with ourselves. If we just stick to our rules and the price comes and hits our stop loss, then boom, we're out of that trade, no questions asked. And this of course leads to benefit number 2, which is we exit out of the trade with minimal losses. Now, of course, there's a knack to using stop losses effectively too, because you've got to allow enough wriggle room for the price to ebb and flow throughout the regular trading activity without you getting stopped out of your position and getting yourself closed out of a trade prematurely. So it's important to not have your stop loss too close. But it's also important to not have your stop loss too far away either, because then you're either running the risk of losing more capital than you want to if the trade goes south, or your trade size is so small because your stop loss is so far away that even if the trade went fantastic, you're in it for such a small amount that it doesn't make a dent. So the trick is to find a good middle ground for where you want your stop loss to be so you don't run into either of these 2 issues. Now, speaking of trade sizing, that now brings us to method number 2 of protecting ourselves and avoiding risk in the markets. So for those who don't know what trade sizing is, here's a simple explanation. Basically, trade sizing is what you do when you decide on how much money you're willing to lose maximum on any given trade. And based on where your stop loss is, you can allocate your resources and the size of your trade itself accordingly. So as an example, if I thought the stock price of company XYZ was going to go up in value and the stock price is trading at $10 a share, I might decide that if the price hits $9 per share, I'm going to assume that I was wrong about where this trade was going to go, and I'm going to put my stop loss in at $9, and the market is going to bail me out at a loss. Now, let's say that I didn't want to lose any more than $1,000 on this trade. So to do that, when trade sizing without leverage, I'd want to be buying $10,000 worth of shares of company XYZ, and once that price dropped to $9 per share, that's when I'd reach my limit of losing my $1,000. And so effectively, trade sizing comes in super handy here because it lets me know what my maximum loss is going to be for any given trade, even during the worst case scenario. So that's thing number 2. Now, the third method of managing risk when trading is to cap your exposure on your account as a whole based on a percentage of your total account's value. So what this means is you basically say, well, if you've got, say, $20,000 in your trading account, you say, okay, at any given time, there's not going to be any more than 25% of that 20K at risk at any given time. So that means on a 20K account, 5K is the most you could possibly lose at any one time if every position you were holding went completely to zero in an instant from some kind of black swan event in the market. And this is where your trade sizing comes in handy because you can actually have more capital in play than the 25%. But because you've taken steps to minimize your losses, we go off the amount that is at risk, not the amount that's being traded as a whole. Now, there's 2 very good reasons why it's important to approach this from a percentage base of your total account's value rather than a dollar figure. The first reason is because dealing with percentages is far less emotional. And remember, as traders, emotion is the enemy. We always want to be looking for ways to make our trading more mechanical and systematic because we're putting our faith in the numbers and science behind why trades are more likely to work out. So by using simple percentages, we take some of that emotion out of our calculations because we're not going by some exact dollar figure, which we're more likely to attach emotion to. Very important. The second reason we like percentages when we're talking about risk is because as your account either grows or shrinks, the percentages stay the same. This means we're allowing a growing account to keep growing at an exponential rate because we're compounding profits on top of profits now by raising our trade size as we grow the size of our account. By the same token, when we're using percentages as our account shrinks, we're actually helping to minimize the risk by lowering our trade size as we take losses, so that subsequent losses become even smaller if we find ourselves on a bit of a losing streak. Of course, the best thing to do when trying to minimize risk is obviously to trade strategies that have been proven to work over time while making larger numbers of trades while keeping the trade sizes relatively small. One thing that's working really well for us here is a little thing called trading the profit zone, where we take trades that are a little more protected than just about any other trade out there, and we create a monthly passive income from trading the share market. Pretty cool strategy. If you want to learn more about that particular method of trading, there's a free video for you to watch over at www.passiveincometrading.com. Please feel free to go check it out. Okay, everyone, hope this has been helpful. Take care and happy trading.